although it's a little tough time, immediate after lunch to get back everyone to work. So I'll try my best to keep you involved. The topic that I've been assigned is IFRS and IFRS for SMEs. So we'll be running through a comparison and introduction of the both of those, and along with certain similarities that we have in both of these. And I would say this topic is very important one, because most of the financial statements that are being audited within the corporate sector either are audited, either are prepared in the framework of IFRS or under IFRS for SMEs generally. So that will be an important topic for today. Okay, so this is the scope that we'll be talking about. We'll be talking about the introduction of both, then the timeline when IFRS for SME got implemented, the scope of both, and for IFRS and IFRS for SME compliance, which includes basically the similarities and where there are differences. So I'll be giving a brief comparison of the two, and the last will be question and answer session. So IFRS for SMEs. The introduction is that ISB basically introduced this simplified version, and the objective was basically to make lessen the disclosure requirements, which are quite comprehensive within full IFRS. So in IFRS for SME, the disclosure compliances are quite less. Then the organization by which IFRS for SMEs are organized, the manner, the way they are organized is a little different from IFRS. IFRS is organized into topics, whereas IFRS for SME is organized into sections. So this is it. Then definitely the disclosure, IFRS talks about over 3,500 disclosures potential that might be applicable to a financial statement, whereas IFRS for SME talks about far lesser disclosure, around 10% of the total. The document in itself, IFRS for SME is around 250 pages document, and whereas IFRS are over 4,000 pages. That's the history for IFRS for SMEs in Pakistan. IFRS for SMEs initially in Pakistan were basically adopted in September 2015 for annual periods beginning on or after January 1, 2015. So these were notified through SECP SRO 929, and before that we were using AFRS for MSCs that were locally prescribed by ICAP. So now these were AFRS for SMEs were replaced basically by IFRS for SMEs. Then initially this was implemented was the version of 2009, and that version was replaced by 2015 version of IFRS for SMEs that is currently applicable and running. So this latest version that is currently applicable is applicable from January 1, 2017. That was the beginning of the period from which it was applicable. Then the scope, basically ISB prescribes IFRS for SME to be used by small and medium sized entities. The definition that ISB runs is that SMEs are basically those who are not publicly accountable, and basically they publish general purpose financial statements for external users. Whereas for Pakistan scenario, this is the third schedule of the Companies Act that governs basically the framework through which we are to which we have to follow that framework. So basically non-listed public company, these are the four categories that are same as described in third schedule to the Companies Act. So non-listed public company, if it has paid up capital of less than 200 million, turnover up to 800 million, and employees less than 750. So they have to follow IFRS for SMEs. For a private company that has a paid up capital of more than 10 million but less than 200 million, that is required. Or turnover 150 million, more than 150 million but up to 800 million. Employees more than 250 but less than 750. For foreign company that has a turnover of less than 1 billion. Non-listed company formed under section 42 or section 45 of the Companies Act, if it has a turnover of less than 200 million. So that is basically the Pakistan scope of IFRS for SMEs. So IFRS for SME is applicable for these companies that I just described. Okay, so these are certain similarities that we have within IFRS for SMEs and IFRS. Okay, so concepts and pervasive principles, statement of cash flows, inventories, provisions and contingencies, liability and equity. These are just basically the same in IFRS for SMEs as well as IFRS, right? So the conceptual framework is the same. IS 7, here the statement of cash flows is prescribed under section 7, whereas in IAS, International Accounting Standard 7, it is prescribed. Similarly, inventories are prescribed in section 13, whereas inventories are covered in IS 2 in IFRS. So, but overall the accounting principles are the same. There might be certain disclosure differences. There will be more comprehensive disclosure requirements in IFRS. These are again certain similar areas: share-based payments, impairment of assets, income tax, hyperinflation, events after the end of reporting period, related party disclosures, and transition to IFRS for SMEs. However, related party disclosures are almost the same in IFRS and IFRS for SMEs. So these are certain similarities. These are the areas which are similar within IFRS and IFRS for SMEs. Now we come to certain areas where there are differences. IFRS for SMEs does not prescribe treatment or separate disclosure requirement for non-current assets held for sale, whereas IFRS definitely prescribes a separate disclosure requirement for non-current assets held for sale. So these have to be shown separately in the statement of financial position. Statement of comprehensive income and income statement. Now under IFRS for SMEs, OCI or other comprehensive income, basically in that statement the items can be foreign currency gains and losses on translation of foreign operations, actuarial gains and losses if actuarial valuation is followed, fair value changes of hedging instruments, and revaluation surplus for PPE. These are the items that are shown in IFRS for SME within comprehensive income, right? However, when we come to IFRS, in addition to these items, there might be other items which are required to be shown in OCI. For instance, changes in fair value of financial assets which are classified as fair value through OCI. So if they are classified as fair value through OCI, so they have to be, so changes in fair value of those is required to be disclosed in other comprehensive income. Then IFRS for SMEs give an option basically that we can combine the statement of income and statement of comprehensive income and statement of changes in equity, and they can be grouped together to form one statement that is known as statement of income and retained earnings, that can be presented in one statement, provided the changes in statement of changes in equity are only from these 4 items that I have listed: profit or loss, dividend payments, correction of errors, and changes in accounting policies. If there are only changes in equity because of these items, then only one statement can be presented, which is statement of comprehensive income and retained earnings. So there is no separate requirement. You can present a separate statement of changes in equity as well as statement of comprehensive income, but you can combine those to present only one statement, right? Whereas when we come to IFRS do not allow such grouping. We have to present separate statement of comprehensive income and a separate statement of changes in equity. Next, notes to the financial statements. So basically in IFRS for SMEs, basically section 8 discusses what are the general nature of notes and the requirements of notes? For instance, statement of compliance with IFRS for SME is required to be given. Accounting policies are required to be listed. Key sources of estimation of uncertainty and judgments is required to be disclosed. Explanatory notes for financial statement items are required as in IFRS. Information not presented in the primary financial statement but that is required for user understanding has to be presented. But when we come to IFRS, so there is no one section that groups all kind of disclosure, but each and individual IFRS describes its own disclosure requirements and we have to comply with all of those disclosures which are applicable. As well as sensitivity analysis and detailed comprehensive disclosure for instance for financial instruments. There is far like market risk analysis and then interest rate risk and price risk. So all of those comprehensive disclosures are required to be given in IFRS. Then consolidated and separate financial statements. Now for consolidated and separate financial statements, there are certain exemptions given in IFRS for SMEs for companies which may be exempted from preparation of consolidated financial statements if the subsidiary is acquired for intention of disposal within 1 year, or the parent itself is a subsidiary and produces general purpose consolidated financial statements with full IFRS. So if this condition, if any of these is met, so we can consider exempt from consolidated financial statements. Whereas in IFRS, this condition is common that the parent in itself is a subsidiary, but there is an additional requirement that there is an explicit consent available from the ultimate parent for not presented consolidated financial statements. But I would say that in my view, there is another requirement which is given in section 228 of the Companies Act, which requires preparation of consolidated financial statements for any parent and subsidiary relationship is established. That section does not specifically give any kind of exemption. So if we consider in the statement of compliance that your statement of compliance explicitly says that whenever there is a contradiction between the applicable law like Companies Act and IFRS, the requirements of the law shall prevail. So in my humble opinion, even if this exemption is available, unless and until that is specifically prescribed in company law, you might still have to prepare consolidated financial statement because of the requirements of Companies Act. Right, non-controlling interest. So that is basically accounted for as a proportionate share of net assets within IFRS for SME, but in full IFRS it prescribes two options. So either the same proportionate share of net assets, or it can be accounted for in the fair value method under IFRS 3. So continuing from the same regarding consolidated financial statements, if there is a disposal of foreign subsidiary, so the foreign currency differences that have already been accounted for in equity, recognized in equity, they are not reclassified to P&L in case of IFRS for SMEs. Whereas for same case, that will be reclassified to P&L for in IFRS. Then investment in a separate, how to account for an investment in separate financial statement, basically subsidiary. So either that investment can be presented at cost or at fair value or equity method within IFRS for SMEs. But when we talk about IFRS, it prescribes cost, equity is common. However, it can be accounted for under IFRS 9. Now, IFRS 9 allows the same, that you can record that at fair value, but that fair value again has two components, fair value through P&L or fair value through OCI. So that is the case. Then accounting policies, estimates and errors. IFRS for SME requires that whenever in deciding accounting policies, basically if the requirements of certain accounting policies is specifically prescribed within IFRS for SME or IFRS, you will follow those. That is a general rule. fair. However, if there are certain transactions which are beyond the scope of specific prescription, like there are certain transactions which are done by a company for which no specific treatment is given in IFRS for SME, then it prescribes a rule that first, in developing accounting policy for that kind of transactions, first we have to look for the requirements of IFRS for SME for similar items. Then either concepts and general pervasive principles prescribed in section 2 of IFRS for SME should be considered, and then requirements of full IFRS. Practically speaking, if there are certain transactions which are not specifically prescribed in IFRS for SMEs, so the general rule would be to follow full IFRS is the transaction basis is prescribed in full IFRS. For instance, construction contracts. Now, for construction contract, there is a specific requirement in IFRS for SMEs. For instance, we can have bearer plants in biological assets. So that treatment is prescribed in IFRS, but not in IFRS for SMEs. Bearer plants in IS 41 is required to be accounted for as an inventory in IS 16, but IFRS for SME does not prescribe any treatment for bearer plants, right? When we talk about IS 8, so the entity should, in developing accounting policies, IS prescribes that you follow the specific guidance of IFRS. If that specific guidance is not given, then pronouncements of standard setting bodies and or industry practices. So these will be governing the accounting policies. Continuing from the same, within the same, if there is a restatement due to error or change in accounting policy, so for that restatement, IFRS for SME does not require a third balance sheet to be presented for statement of financial position. It does not require that a third comparative balance sheet is to be presented. Whereas IS 8 specifically requires that if there is a material change due to error or due to change in accounting policy, then then third balance sheet is required to be presented. So basically 3 statement of financial positions are presented in IS 8. Now we come to the next important area, financial instruments. Now for financial instruments, basically the difference is quite extensive. Specifically, there is a detailed disclosure requirement within IFRS, but IFRS for SME requires far lesser disclosure for financial instruments. The recognition and measurement principles are prescribed in section 11 and 12. 11 prescribes basically the basic financial instruments, and 12 prescribes certain advanced financial instruments in IFRS for SME. And for recognition and measurement, it gives out options that either you follow section 11-12 or it gives an option that we can follow IAS 39. So that is an exception. As against IFRS, IFRS requires to follow IFRS 9, 7 for disclosures and 32 for definitions, right? For initial measurement, basically all financial instruments are measured at cost plus or minus transaction cost, except for fair value through P&L. Fair value through P&L, in that case, automatically transaction cost will be charged to P&L. In case of IFRS, for financial assets financial instruments at amortized cost and financial assets at fair value through OCI, financial instruments are measured at fair value. For fair value through P&L, financial instruments are measured at fair value and transaction cost is charged to P&L. For subsequent measurement, financial instruments are measured at amortized cost or fair value, but it gives an option that you can measure at fair value if fair value is measurable or determinable without undue cost or effort. So then you are required to measure that financial asset at fair value. So for recognition and measurement, IFRS require that we have to follow IFRS 9, IS 32 and IFRS 7. For initial measurement, basically for financial assets at amortized cost and OCI fair value plus or minus transaction cost. Transaction cost for fair value through P&L will be charged definitely, वो P&L है तो PL it will be charged to P&L. Subsequent measurement. Now for subsequent measurement, it will be fair value through P&L or fair value through OCI or amortized cost. So these three are the options within full IFRS. Next is basic financial instrument. Now we talk about impairment. So in case of impairment, financial assets are measured either at cost or amortized cost. So whenever a loss is incurred, which means the conditions are indicated, the loss is probable, only when recognized, then that has to be accounted for within IFRS for SMEs. But when we come for IFRS 9, it requires expected credit loss method that has to be applied for all financial assets. So in that case, even if you expect a loss that has not yet been incurred, we have to account for. Now section 14 and 15 covers basically investments in associates and joint ventures. For investment in associates and joint ventures, they are accounted for under IFRS for SME either at cost or equity method or fair value through P&L. Fair value through and under full IFRS it will be required to be accounted for only under equity method. So there is no other option available. In case of joint operations, basically it is similar to IFRS. IFRS for SME is similar to IFRS, and we have to record assets and liabilities that are controlled and share of income and expenses according to the proportion that we own. Then we come to investment property. Initially, the investment property is measured at cost under both IFRS and IFRS for SME. Then at subsequent measurement, it can be accounted for at fair value. However, it gives an option that if fair value you are unable to determine fair value without undue cost and effort, so then still you can keep it at cost. Whereas in IFRS we have to measure either at cost or at fair value. Borrowing cost. For borrowing cost, which is generally in IFRS, it is covered in IS 23. So borrowing cost, it allows certain borrowing cost for qualifying assets to be capitalized. It allows. However, there is no such prescribed treatment in IFRS for SME, and all borrowing costs incurred have to be expensed, charged to P&L. For disclosure requirement, the difference is basically that prior period reconciliation is not required in IFRS for SMEs, whereas IFRS required a detailed reconciliation for prior period as well in addition to current period. Then we come to property, plant and equipment. Basically, for property, plant and equipment, the review of residual value, useful life or amortization method is required annually in IFRS. We have to review it. If there is a change, then they have to be adjusted. Whereas in IFRS for SME, no annual review is required, only if there is an indication that either useful life has changed or the amortization method does not basically commensurate or is not in line with the usage of that asset. So only if that condition is there, then that has to be reviewed again. Again, that borrowing cost for property, plant and equipment, if for any capital work in progress is incurred, for IFRS for SME it has to be expensed, and for borrowing cost IS 16 it can be capitalized for qualifying assets. Disclosure, again the same difference. Basically, the prior period reconciliation is required in IFRS, whereas it is not required in IFRS for SMEs. Intangible assets other than goodwill. Development cost. IFRS allows that can be capitalized if certain conditions are met. However, in IFRS for SMEs, development costs have to be expensed out. Intangible assets for other than development cost have to be measured at cost. Revaluation model is not there. However, IS 38 does prescribe that subsequent measurement can be at revaluation model for assets, intangible assets other than goodwill. Then IFRS for SMEs gives a basically finite useful life for intangible assets. It can be up to 10 years if a reliable estimate can be made, however not more than 10 years. So basically it cannot have an indefinite useful life under IFRS for SMEs, whereas in IFRS it can have an indefinite useful life. However, if the management is of a view that intangible asset has an indefinite useful life, then an annual impairment assessment is required under IFRS, whereas there is no such requirement in IFRS for SMEs. Disclosure, similar difference that reconciliation of the prior period is not required in IFRS for SMEs, whereas it is required in IAS 38. Now, business combinations and goodwill. There are certain areas that are not covered in IFRS for SMEs, but they are specifically prescribed in IFRS. For instance, step-by-step acquisition, a business combination that is achieved without transfer of consideration, and certain recognition and measurement of following items is covered in IFRS. For instance, shade-based payments, indemnification assets, reacquired rights, leases in which acquiree is the lessee, assets held for sale, insurance contracts. So these are certain things that are specifically discussed in IFRS but not prescribed in IFRS for SMEs. Then for business combination, in IFRS for SMEs, transaction costs are basically part of cost of investments. But in IFRS, transaction costs are not part of cost of investment and they are to be charged to expense. Goodwill is amortized, but in IFRS, goodwill is not amortized but tested for impairment annually. Negative goodwill is recognized in P&L. However, there in IFRS, basically negative goodwill nomenclature does not exist, but it uses the term gain on bargain purchase and it recognized the same way. Contingent consideration is recognized only when probable. And in IFRS, contingent consideration is recognized regardless of probability of recovery. Now we come to leases. So for leases, IFRS for SME differentiates definitely leases in the traditional way, finance lease and operating lease. And finance leases are recognized at fair value or present value of minimum lease payments. In case of IFRS 16, all leases are capitalized. And the new concept basically that has been given by IFRS 16 is that you can also recognize operating lease on the statement of financial position as a right of use asset, and that right of use asset is amortized over the lease term. So if the only condition is that the lease should not be short term, at least it should be an year or more, so then it can be recognized as a right of use asset, and that has to be amortized over the term of lease, right of use asset, under IFRS 16. Lease liability is the present value of future cash flows discounted at the interest rate either implicit in the lease of that, or if that is not available, then lessee's incremental borrowing rate. Here the operating leases are expensed out, a charge to P&L. So for operating leases cannot be recognized under IFRS for SMEs on statement of financial position as an asset. So that is basically the principal recognition and measurement difference between the two. Minimum lease payments include finance charge and reduction and the reduction of the principal amount. And here in IFRS again the same lease liabilities are amortized. However, right of use asset is depreciated over the lease term. So there is no right of use asset basically in IFRS for SMEs. For provisions and contingencies, there is no big difference between the two, and basically the difference is basically that IFRS for SME requires to disclose comparative information, does not require comparative information disclosure, whereas IS 37 requires comparative information as well in addition to the current year for any kind of provision and contingencies. Now revenue. Now that's a critical area that is basically quite different in IFRS 15 as well as compared to IFRS for SMEs. IFRS for SMEs principally describes similar conditions that were there previously in IS 18 revenue, but that has definitely been changed by IFRS 15. Under IFRS for SMEs, revenue is recognized similarly on the transfer of risk and rewards. So that model is still there, that risk and reward have to be transferred, and the conditions are the same, which we will discuss a little later. Separate guidance is given for construction contracts and prescribes recognition criteria for sale of goods, sale of services, construction contracts, interest, royalties and dividends. So the separate criteria are given in IFRS for SMEs. So these are the same, if I remember correctly, that IS 18 used to give us. But now IFRS 15 is entirely different. Revenue is recognized on transfer of control and not only risk and reward. If that transfer of control is simultaneous with risk and reward, yes, you can recognize. But if that transfer of control is not there, so the revenue cannot be recognized unless transfer of control is there. Then basically the revenue is recognized and linked to performance obligations, and it describes a detailed procedure basically how to identify each and every performance obligation separately, and then revenue is recognized on basically delivery or execution of that specific performance obligation. So simultaneous with actually delivery of that performance obligation, you can recognize revenue to that extent. So basically the full revenue is split into individual revenues for each performance obligation, that is split into revenue for each performance obligation, and then revenue is recognized to the extent of each and every performance obligation when it is completed or executed. No separate guidance is given in IFRS 15 for construction contracts. So it has to be dealt with in same principles as given in IFRS 15, basically performance obligation. Now again the revenue recognition criteria within IFRS for SMEs is the same for sale, is the same as IS 18 used to have it. For sale of goods, basically transfer of risk and reward is a condition, then there should be no continuing involvement of the seller, amount should be reliably measurable, economic benefits are there and are probable to recover, and costs are measured reliably. So if these 5 conditions are there, so revenue can be recognized in IFRS for SMEs. For sale of services, percentage of completion method is there. To the extent of completion of service, we can recognize revenue for that portion. Cost recovery method is also there. Outcome, if outcome of the service cannot be reliably measured. For construction contract, again the percentage of completion method is prescribed in IFRS for SMEs. Cost recovery method is there if basically the probability of recovery is not measurable. Interest is measured at effective interest rate method. Royalties are measured at accrual basis, and dividends are recognized when the right to receive is established. So these are the basically recognition principles difference between IFRS for SMEs and IFRS. Now we come to government grants. Now, if a government grant is repayable, repayment when repayment of a government grant is done, that specific accounting policy or treatment is not prescribed in IFRS for SMEs, but IFRS covers that as well. For government grants, basically the difference is that IFRS for SMEs recognizes the government grant according to the nature of the grant. If there is no specific performance restriction, we can recognize the government grant as income immediately under IFRS for SMEs. If there is some specific performance conditions attached to a government grant, so when the conditions are met, you can still immediately recognize that revenue. Then if the grants received before the revenue recognition as criteria is satisfied, so they have to be accounted for as a liability and can be recognized as revenue when the conditions are met. Whereas in IS 20 IFRS, there are two approaches given. One is capital approach for accounting policy of government grant, and other is in which basically in capital approach the grant is recognized outside P&L, or it can be netted off from the cost of that asset. If it is a capital approach, basically the grant related to assets. So either you can net off the cost of asset from that government grant, or that can be separately accounted for, and that has to be charged separately to P&L over the life of the asset. Under the income approach, basically the grant is recognized in P&L over one or more period, basically accounted for on a systematic basis rather than recognized immediately in case of IFRS for SMEs when the conditions are satisfied. Income in grant income cannot be recognized in IFRS unless there is a reasonable assurance that the entity complies with the condition attached to the grant and the grants are receivable. So if these criteria are met, then government grant can be recognized. Employee benefits and specialized activities. Now for employee benefits or retirement benefits, defined contribution is accounted for in a similar manner, that undiscounted amount is recognized in P&L, the contribution, and the changes are recorded in P&L if there are any. So similarly it is accounted for in IS 19, but if the defined contributions are payable after 12 months, then it requires that contribution should be recorded at present value. For defined benefit plan, the basic difference and major difference is that actuarial valuation techniques are not mandatorily to be followed in IFRS for SMEs, whereas in IS 19 you have to recognize the employee retirement benefits by following actuarial valuation techniques. So that is mandatory, and then definitely it results in either actuarial gains or losses that are recognized, and there are past service cost or current service cost that is traditionally recognized as given in IS 19. However, the major difference stays the same, that simplified approach in IFRS for SMEs, which means for medium-sized entities, a simplified approach for recognizing employee benefits is allowed. The simplified approach means last drawn salary, generally last drawn salary multiplied by the number of years of completed service. So that can be recognized in IFRS for SMEs, but that simplified approach is not allowed in IFRS. You have to follow actuarial valuation techniques, that is mandatory. Then for specialized activities, basically if you talk about agriculture, So for agriculture income, it has to be recognized at fair value if the fair value is readily available without undue cost or effort. However, under IAS 41, it is measured at fair value. Then what I was referring to earlier, bearer plants are not specifically discussed in IFRS for SMEs, whereas bearer plants are accounted for under IAS 16 as an inventory under IFRS. So these are certain major differences between IFRS for SMEs and IFRS. So if there are any questions, please. Please. माइक आपका ऑन नहीं है शायद. जी.
IFRS फॉर SMEs में इन्वेस्टमेंट इन सब्सिडरी वो फेयर वैल्यू पे मेजर हो सकती है इन सेपरेट फाइनेंशियल स्टेटमेंट्स?
जी, फेयर वैल्यू पे मेजर हो सकती है. एक लेट मी रेफर बैक. जी, इन्वेस्टमेंट इन सेपरेट फाइनेंशियल स्टेटमेंट कैन बी मेजर्ड एट फेयर वैल्यू, इक्विटी मेथड और कॉस्ट. सेपरेट फाइनेंशियल स्टेटमेंट. जी
सर, इन केस ऑफ IFRS अगर इन्वेस्टमेंट एज ए सब्सिडरी है मोर देन 50%, तो फिर भी IFRS 9 अलाउस इन सेपरेट हो सकता है?
जी, अलाउस. IFRS 9 में है अलाउ. वी कैन रीचेक इफ रिक्वायर्ड. चेक कर लेते हैं नीचे. एनी अदर क्वेश्चन प्लीज?
अच्छा सर, सेकंड सर क्वेश्चन में ये था कि अगर एक स्टैंडर्ड डील नहीं करता एक ट्रांजैक्शन को, जैसे कि स्मॉल साइज़ के स्टैंडर्ड्स हैं वो बायोलॉजिकल एसेट को डील नहीं करते, लेकिन कंपनी की ट्रांजैक्शंस हैं बायोलॉजिकल एसेट्स की, तो उस केस में कंपनी फॉलो कर सकती है IAS 41 की पॉलिसीज़?
बिल्कुल. देखें, अभी हमने ये बात की ना शुरू में, हमने इसमें बात की थी that if a transaction is not specifically covered with IFRS for SMEs, तो आप क्या करेंगे? Number one, you take guidance from full IFRS या complete IFRS. उसमें अगर वो ट्रांजैक्शन का अकाउंटिंग ट्रीटमेंट प्रिस्क्राइब्ड है तो आप वहाँ से गाइडेंस लें, या इसमें वो इंडस्ट्री गाइडेंस भी आपको अवेलेबल है. ये देखें, अकाउंटिंग पॉलिसीज़ में बेसिकली आप अकाउंट फॉर अगर आपके पास अकाउंटिंग पॉलिसी में स्पेसिफिक गाइडेंस अवेलेबल नहीं है विद इन दैट स्टैंडर्ड, अगर IFRS फॉर SME में, सो द जनरल रूल इज दैट यू गो टू IFRS एंड टेक गाइडेंस फ्रॉम देयर. इफ दैट इज प्रिस्क्राइब्ड देयर, तो उसकी अकाउंटिंग पॉलिसीज यूज़ कर लें, और टेक जनरल गाइडेंस फ्रॉम परवेसिव प्रिंसिपल्स दैट आर प्रिस्क्राइब्ड इन सेक्शन 2 ऑफ IFRS फॉर SMEs. वहाँ से गाइडेंस ले लें. राइट
सर, उस केस में IFRS को रेफर करना होगा या जस्ट आप एज ए अकाउंटिंग
पॉलिसी देनी होगी ना? अकाउंटिंग पॉलिसी मेंशन करनी होगी कि इन सच केस. देखें, उसमें ये रिक्वायर्ड एग्जैक्टली नहीं है कि आप लिखें कि मैं IAS 41 की पॉलिसी फॉलो कर रहा हूँ. आप ये रिक्वायर करें कि IAS 41 जो रिक्वायर कर रहा है वो अकाउंटिंग पॉलिसी मेंशन कर दें डिटेल्स.
जी ठीक है.
या लेट से कोई भी स्पेसिफिक स्टैंडर्ड जो रिक्वायर कर रहा है वो पॉलिसी मेंशन कर दें IFRS की, कि जी आई एम फॉलोइंग दैट अकाउंटिंग पॉलिसी फॉर दैट.
और सर लास्टली अभी कुछ अमेंडमेंट्स हो रही हैं इसमें IFRS फॉर SMEs में, जो कंसीक्वेंशियल चेंजेस हैं, जैसे कि आपने बात की थी IFRS 15 में रेवेन्यू रिकग्निशन काफ़ी डिफरेंट है.
जी.
IFRS 16 लीजेस भी है, तो ये कब तक एक्सपेक्टेड है इम्प्लीमेंटेशन इसकी इफेक्टिव इन पाकिस्तान?
अभी तो देखें उसके लिए उसका एक प्रोसेस है कंप्लीट। पहले वो ICAP में आएगा, एक डिस्कस होगा और उसकी इवैल्यूएशन की जाती है कि इम्पैक्ट क्या आएगा, किस तरह होगा, और उसका एक पूरा प्रोसेस टेक्निकल सर्विसेज डिपार्टमेंट रन करता है। उसके बाद व्हेन और वो ICAP की कमेटी में, अकाउंटिंग स्टैंडर्ड्स कमेटी में डिबेट होता है, डिस्कस होता है, एंड दैट कमेटी आफ्टर मल्टीपल सेशंस उसके सारे प्रॉज एंड कॉन्स को इवैल्यूएट करके, डिस्कस करके, देन इट गिव्स एन इम्प्लीमेंटेशन प्लान, और फिर वो सजेस्ट किया जाता है SCP को फॉर नोटिफिकेशन, राइट?
सही।
तो अभी कोई स्पेसिफिक डेट इस पे नहीं है, अनलेस एंड अनटिल दैट इज़ फाइनलाइज्ड बाय टेक्निकल डिपार्टमेंट एंड अकाउंटिंग स्टैंडर्ड्स बोर्ड, और वो उसको सारे को इलेबोरेट करके फिर उसको रिकमेंड करेंगे।
ओके, थैंक यू सर।
वेलकम। सर,
अगर एक SME है जो कि IFRS पर SME अडॉप्ट किए हुए है फॉर कपल ऑफ ईयर्स, फिर वो डिसाइड करती है कि ऑप्शन है ना,
जी जी,
वो फुल IFRS को
जी बिल्कुल
ऑप्शन कर लेती है, देन देयर आफ्टर अगेन आफ्टर सर्टन ईयर्स क्या उसके पास ये ऑप्शन होएगी कि अगर वो स्टिल SM ही फॉल करती है तो वो वापस IFRS पर SML?
अच्छा देखिए सर, नहीं ये बात
SME को adopt
ज़रा सी
करना।
मुश्किल है। देखें जब हम जाते हैं ना एक सर्टेन एक्टिविटी पे, हमने एक इनिशियल व्यू ये लिया कि सिंस IFRS आर बेटर प्रेजेंटेड एंड गिव्स एक्सटेंसिव डिस्क्लोजर्स, और यूज़र्स ऑफ फाइनेंशियल स्टेटमेंट के लिए ज़्यादा बेहतर इन्फॉर्मेशन और अप्रोप्रिएट इन्फॉर्मेशन मिल जाएगी विद इन फुल IFRS, और इस बेसिस पे हम IFRS फॉर SME के बजाय वॉलंटरली IFRS पे गए, दैट इज़ गुड। नाउ टू गेट रिवर्स बैक टू दिस, that requires a full justification. Now that justification would be very difficult to be given कि जी अब कैसे ये justify किया जाए कि IFRS पहले voluntarily मैं एक extensive level पे चला गया, now how to justify कि अब मैं reduced level पे आ जाऊँ, that will also be justified. दोनों काम नहीं ठीक हो सकते, मुश्किल होगा।
So which document or which para requires this justification?
नहीं, I'm just saying that will be difficult to argue, but still that can be discussed.
That can be done.
मैं इस पे वर्डिक्ट नहीं दे सकता।
मतलब कि
नहीं मैं इस पे वर्डिक्ट
consistency जो है
नहीं, इस पे मेरी रिक्वेस्ट होगी,
jeopardize हो रही है ना।
हाँ इस पे मेरी रिक्वेस्ट होगी कि आप एक स्पेसिफिक क्वेश्चन ICAP टेक्निकल सर्विसेज डिपार्टमेंट को एड्रेस कर दीजिए, ताकि वो पूरी कमेटी डिबेट करके आपको आंसर रिप्लाई करें।
ठीक है,
थैंक यू।